Hey everybody, so I haven't made a video in a while and I wanted to talk about Netflix because there's a lot going on here. And I'm sure you've seen other YouTubers talk about Netflix or whatever, but I'm just going to go over Netflix in my own way. So right now we're on the Netflix investor page and there's three good pieces of information you could find here. You could look at the letter to the shareholders, the financial statements, and the transcript. And I'm going to kind of show you some benefits of looking at all three of these. So one thing I want to go right into is the financial statements. So what I'm really going to focus on right here is the earnings per share figure. So in this last quarter that they reported basic EPS of 3.6 and 3.53 for diluted. Now, if we're comparing this to the last year, same quarter actually came in stronger. But this year's quarter actually beat analyst expectations. So if we're looking at the trailing 12 months and we're looking at the diluted, because we want to be conservative, we see 11.24. Now let's jump over to the stock price and then let's calculate what the PE actually is. So it's going to be the stock price divided by the EPS, which is 11.24. So right now we're trading at 9.41 price to earnings. Now, a lot of people might say, oh, that's really cheap, or, they think that Netflix is super cheap right now. But what I want to point out to you is that Netflix has been overvalued for a very long time, especially at $700. People are paying a serious premium for Netflix. So right now it's just getting to be fair value, but do you really want to pay something close to 20 PE for Netflix when their subscriber growth is looking a little bit weak and when their growth prospects are looking a little bit weak? And especially if the economy is not going to do good, maybe you want to pay something like 15 PE and you want to be a little bit more conservative. So we could calculate what a 15 PE on Netflix would be, and maybe that might be a good price to make a starter position. So what we're going to do to find that calculation, we're going to do 11.24 times 15, because we want to forecast that earnings per share in the future is going to be a little bit weaker. So if we're being conservative and we're looking at 15 PE, we'll see Netflix at 168.6. Maybe that would be a good time to just get a little bit into Netflix and dollar cost average a little bit. So here I'm giving you a figure that would probably be on my higher end, like 170-ish. That might be like a little bit higher. Now, if I wanted to be a little bit more conservative, we could say, hey, maybe like 13 PE, and we could calculate what 13 PE is. Now, that's going to be 146. So let's just look at the Netflix chart. I mean, it looks so ugly right now. I'm just looking at where I think we could find support. Oh boy, maybe we'll find support at 200, maybe. So let's just draw a line right there. And if we break 200, where are we going to find support next? The problem with Netflix is that it's just been going up and up and up and up, and now it's just crashing. I mean, this is like a serious crash. So where could we even fall? I mean, let's just look again. Let's find a next point. I would think the bottom of this massive bar right here. Let's see what that is. That's about like 160. Yeah, so about 162 would be the bottom of this green bar right there. So, I think, that could happen. I think that could very realistically happen, 162. And then if we fall even more, oh, yikes, like let's say right here at like 130-ish. So yeah, 130 would be probably, let's just calculate what the PE would be at 130 based off today's earnings per share. Yeah, that would be like 11.56. So I don't think that's going to happen right away. I think, that could happen if they continue to make these lower earnings per share numbers. So there's also one more thing I want to point out on this Netflix chart. Look at this volume. That's insane volume. And I'm going to show you just how insane it is. So we're going to go on Yahoo Finance. And when I look at Netflix on the quotes, I could look up the volume right here. So on selling volume, April 20th, we had 133 million shares on selling volume. So that's pretty insane. Now, let me just scroll down for you to kind of show you how abnormal this is. So this very last column, that's volume. So we're just going to keep scrolling down. Do you see anything more than 100 million? Because I don't. I mean, I could keep scrolling down for you. I mean, we see about 60 million right here. That was around earnings last time. Keep scrolling down. I mean, I'm not seeing anything. I'm not even seeing anything over 60. I mean, I could scroll down for ages. I mean, I'm just going to keep scrolling down here to make a point to you guys that, that amount of shares being traded, that's not normal. It's not anything near normal. And it's saying that investors are very fearful. And you're seeing probably a lot of growth investors just flee. These are, it's probably on an institutional level. Do you guys see anything over 60 million? I don't. I mean, I could probably scroll for ages and I probably still wouldn't see anything over 100. Yeah, that's the point that I'm getting at, is that this is massive selling volume. I mean, just look at that candle bar. Let me just zoom out 5 years. When's the last time we saw this volume? Last time we saw this kind of volume was in 2015. So you can see that bar right there. And 2014. But we haven't seen this kind of volume in, yeah, over 6 years. So definitely something to pay attention to. I think we're very likely to see a little bit more selling. And, as ridiculous as it seems, we could keep selling off here, just looking at this volume profile. And we'll continue our analysis here. So another thing that I want to pay attention to is when I go on Yahoo Finance and I'm on the balance sheet, we're going to look at ordinary share number. Now, Netflix is a FANG stock, and most of FANG, and by most, I mean Apple, Microsoft, and Google, the ordinary share number is going down on those companies. But for companies like Netflix and Amazon, these numbers actually go up. So, you might think that being in FANG, you're cushioned, but I mean, if you're in Netflix, you're not as cushioned because are they offering dividends? Not that I know of. And are they buying back shares faster than their stock-based compensation program? Well, this shows that they're not because look, we're growing. We had 436 million, and then now we have 443 million or 444 million. So yeah, this number is growing, and that's never a good thing. So we're going to go back to actually, we're going to just jump right into the shareholder letter. So here, they give us a little greeting. And one thing I noticed right away is that they're saying that they're going to hold their operating margin around 20%. So they give us this really nice visual here. And let's see, I'm going to zoom in on this for you guys. Let's just pay attention to this visual right here. So here they give us revenue. And we can see that the year-over-year growth on revenue is looking weak. I mean, see here we see 24%, 19.4, 16.3, 16, and then we see this sudden crush all the way down to 9.8%. And then they're even forecasting 9.7%. So what exactly is year over year percentage growth, and how do you calculate this? Well, I'm going to show you that real quick. So what they're doing is they're comparing Q1 of 2022 to Q1 of 2021. So they're getting this revenue figure right here. So let's just put that in, 7868. We're going to subtract that from Q1 2021, which is 7163. And then we're going to divide this number, which is the difference of revenue from these two periods, by the base period right here. And then this is a percent, so we're going to multiply by 100. So now we get 9.84, and which they show right here, 9.8. They just round it up, or they round it down actually. So that's how you calculate this year over year percentage growth. Now, I also do want to point out one more thing. Look at the operating margin. So operating margin right here, 25.1%. Now for the next quarter, they're looking at 21.5%. And you see that revenue is growing. So revenue is growing, but operating margins are going down. So that means that costs are going up, which, it's not a big surprise, just given the current environment. So the way that I want to, the way that you show that, the way that you calculate this is we get our operating income. So I'm going to punch it in for Q1 2022, 1972. And then we're going to divide this by our revenue, which is 7868. And then we multiply that by 100 because it's a percent. So here they round it up. So 25.1%. That is how you calculate operating margin. And then they even give us a diluted EPS forecast of 3. So if you watch my last video, you can actually calculate the 12-month trailing 12 months trailing EPS, and you can actually calculate the forecast because they gave us a forecast number right here. So you could get 12 months, including this forecast, and then calculate the new EPS. And then you could reconfigure your PE ratios. And I'll leave a link to that video down below. So this is some pretty good information right here. It's probably the best information you could find. And let's see if there's anything else here. Yeah, now they're giving us global streaming paid memberships. And we see this number going down for Q2 2022. So that's not good. And we see that this number went down also for this current quarter. So that's one of the big reasons why we're selling off, because prior, we were just constantly growing this number. Now, all of a sudden, we stopped. And not only did we stop, we fell below the prior quarter. And then we're even guiding that the next quarter is going to be worse. So let's just continue on. All right, so one of the reasons why they're guiding lower is, they're saying that over the last 3 years, a lot of companies realized that streaming is the future. So now many new streaming services have launched. So, they're saying competition is a big reason for this. And if we go onto their, let's see, what do we call it? If we go onto the transcript of the actual earnings call, we could see the questions and the answers, the Q&As. So this guy, his name is Douglas. He works at JP Morgan in the research division. And right here, he's talking about the subscriber growth. So he says you lost 200,000 subscribers or gained 500,000, excluding the Russia removal. So now he wants to find out a little bit more about our the Q2 guide for the loss of 2 million subscribers. So now we have the CFO, Spencer Adam Newman, and he's going to answer this question for us. So let's see here. He says the difference is really some slightly elevated churn through Q1. So when they talk about churn, they're talking about subscriber loss. So if you are subscribed to, let's say, Chegg, and you're a student and you're going to school like me, and you're subscribed to Chegg and you're getting homework help, all of a sudden you're done with school and now you don't need Chegg anymore, so you unsubscribe. So that's basically churn. That's what they're talking about. So they're also contributing it to the spillover effects from the Russia-Ukraine invasion. So they're saying that we suspect some of that is those micro factors we mentioned and maybe a little bit of competition on the margins as well. So to me, this sounds like they're not saying competition is a big factor. So, they're underestimating competition here. And they're saying a lot of it is due to a spillover effect from the Russia-Ukraine invasion. And that's what's affecting the slightly elevated churn. A little bit more. And this same guy, Douglas from JP Morgan, now he's talking about what Netflix is going to do for the monetization, because they mentioned that one of their big problems is that a lot of people are sharing the subscription. So, you got some people who are just freeloading, and, they're freeloading off your subscription and they're not paying for any of it. So this guy is saying, but I guess when we think about account sharing, and just curious about the early testing that you're doing when you think about Chile and Costa Rica and Peru, I guess now it's pretty clear to see why it's the right time to do this in a bigger way. But how do you think about rolling that out in the US? And what will the implementation actually look like? So what is Douglas actually talking about? So I'm going to tell you exactly what he's talking about. So there's this nice little page here. It says paying to share Netflix outside your household. So this is Netflix. This is one of their solutions to try to figure out this problem that they have with monetization. So what they're planning on doing, they're saying add an extra member. Members on our standard and premium plans will be able to add sub-accounts for up to 2 people they don't live with, each with their own profile, personalized recommendations, login, and password at a lower price of whatever the heck this is, $2.99 USD in Costa Rica and 7.9 pen in Peru. So if we're looking at Costa Rica price, $2.99 USD, that's not a whole lot. And they're going to do this in, let's see, and over the next few weeks, we'll launch and test 2 new features for our members in Chile, Costa Rica, and Peru. So they're doing this in these 3 countries. And this article was made March 16th of 2022. So it's rather recent. So they're planning to do this, add an extra member for your household that's not part of your household for a lower price. So that's kind of one of their solutions. So I don't really know how this is all going to work out, but if we look at that guy's question, see that, let's see. Find it again. Ah, yes, so right here. So basically what he's saying is that, we can include it in the US markets, but it's going to take them a year or so. So that's basically what they're saying, and they said that this is their first big country test. So one of the things that I wanted to point it out on the actual transcript. So it's always good to listen in on these or actually read the transcript itself. So, we could watch the video interview or we could listen to the transcript. So let's see, was there anything else I wanted to talk about? Let's actually continue down this shareholder. Do you think there's a few other things? Yeah, so right here, they're talking about how to best monetize. I really can't say that word. Monetize sharing. So right now, they're estimating that there's over 100 million plus households using another household's account. So they see this as an opportunity, or at least that's how they're trying to spin this off. So if they could figure out how to solve this problem, that's going to be big bucks. Now, another thing that I really noticed when I was reading this, they said, as we work to monetize sharing, growth in ARM, revenue, and viewing will become more important indicators of our success than membership growth. So, they see how stock price is reacting from the membership growth, and now they're trying to veer us over to revenue per membership. So, that's always interesting to see how they're kind of twisting their words and stuff like that. So, their goal is to sustain double-digit revenue growth. But, as we saw in those previous projections from that little table, right now we're looking at under 10%. So, that's not too good. So, they're trying to get back into that double-digit revenue growth. So, that's their goal. And let's see, is there anything else? Yeah, so this is just going off a little bit more on what that one guy from JPM was saying. So paid net additions were negative 0.2 million compared against our guidance forecast of 2.5 million. So they were saying that 2.5 million subscribers were going to be added, but what we basically got was negative 0.2 million. And they're saying Russia paid memberships resulted in a negative zero point 0.7 million impact. And if we exclude that, then we actually see a 0.5 million addition. And here they're saying we still target a 19 to 20% operating margin for the full year of 2022. So we saw that their forecast earlier for the next quarter was around 21%. So they're saying that like 19% is going to be the lower end of that. So something to pay attention to. Now, if we're looking at their cash flow and capital structure, well, they give us a little bit of information on that. They say, we continue to expect to be free cash flow positive for the full year of 2022 and beyond. And they talk about during this quarter, they completed 2 acquisitions. And here we see a negative 125 million impact on cash from these acquisitions. They also said that they paid off some debt. They repaid 700 million of their senior notes. And basically they said, given those uses of our cash and our minimum cash target, we didn't engage in share repurchase activity during the quarter. So something to keep a note on. Let's see. Basically all my notes for Netflix. I hope you guys enjoyed this. And definitely leave a like, subscribe, or comment if you want to see any more information or any other future earnings that you want me to cover. And have a great one.